Get grandfathered to stay tax-free even if Congress changes tax laws. In this episode, I'm going to answer the question, what if Congress or the IRS does away with tax-free advantages of indexed universal life insurance? Get ready. I'm going to share some things with you that most advisors don't even know. So I'm Doug Andrew, and I've been doing this for more than 46 years, helping people optimize their assets with one of my favorite vehicles, a max-funded indexed universal life insurance policy since 1997. Prior to that, a fixed universal life since 1980 when they first came out. It is the only vehicle in the Internal Revenue Code that allows you to accumulate your money totally tax-free, be able to access that money anytime, totally tax-free, and when you ultimately die, it blossoms in value, it increases in value by double, triple sometimes, or more, and it transfers income tax-free. Nothing else does that in the Internal Revenue Code. You can learn why and how in some of my other episodes, because that has been a sacred cow in the Internal Revenue Code for over a century, since I think 1913, where Section 72E allows you to accumulate your money inside of an insurance contract tax-free, because you're taking pressure off of the government to take care of widows and orphans or people in retirement, and so they give you tax advantages. If they taxed it, then they would be shooting themselves in the foot, okay? It allows under Section 7702 for you to access money income tax-free because you're using it usually for retirement, and you don't want to rely on the government having to shell out money or welfare or whatever. And so this will help people not be totally reliant on government programs. And so it's been a sacred cow, tax-free when you access money. And Section 101A of the Internal Revenue Code says that when you ultimately die, whatever is in there, it blossoms in value and transfers tax-free. On that last point, let me just illustrate by saying I'm 68 and a half right now. If I died tomorrow in an accident, about every million that I would have in indexed universal life insurance policies would blossom to about 2.5 million and transfer income tax-free immediately to my wife, to my kids, my grandkids, church, charity, whoever I leave it behind to as a beneficiary. Nothing else does that in the Internal Revenue Code, allowing you to accumulate, access, and transfer your money totally income tax-free. Municipal bonds don't do that. Roths don't do that. They don't blossom when you die. So that's why it's one of my favorite vehicles or dream solutions for many goals, not just retirement, but college funding, because you don't have to wait till you retire to access money tax-free. I have business owners that use it for working capital, and they're in their 30s and 40s. I have people using it because they retired when they were 38, because they built up a business, sold it, and put the money into a max-funded portfolio of indexed universal life. So when we talk about, golly, this is so phenomenal, people say, this sounds too good to be true. I'll bet you when the IRS finds this out, I'll bet when Congress figures this out, they'll take away those tax advantages. Well, let me tell you what I tell them. Number one, this is not a secret. The IRS and Congress is very well aware of these. They are the ones who set the parameters, the rules. They say, if you'll do it this way, it's tax-free. This is the smart way to take it out. Use a loan instead of a withdrawal. They're the ones who say, hey, this is an advantage. Why would they say that? I'll share with you why, but this is no secret. They know what they are doing. It's not like this is a loophole, and when they find this out, they're going to close it up. They've been tempted sometimes government revenuers, I call them, who are hungry for taxes, consider taxing these. And the last time they did that was in 1990. And I'm going to tell you the 3 conclusions they came to when they were getting greedy back in 1990. Hey, let's consider taxing the inside buildup of insurance policy cash values. There are trillions in there. Let's go get some. And this is the conclusions they came to. This was a report about this thick. I still have a copy of it. It had a blue cover on it, and it said, should we tax the inside buildup of cash value inside of permanent life insurance policies. So this also included whole life, but especially universal life, because it was outperforming whole life by a lot. Even by 1990, it had been around only for 10 years, but they could see where this massive exodus of money was leaving the banks, the credit unions, the brokerage firms into these universal life policies because they paid higher interest. They were tax-free. They blossomed when you died, and nothing else could do that. So they said, should we tax them? After months of study from the General Accountability Office, the House Ways, Senate, and Finance Committees, okay, they looked at all of it, and these were the three conclusions they came up with. Number one, they were smart enough to do the math, and they realized that if they taxed them and they took 20 or 30% like they normally do out of income and what have you, if they taxed them, because of the strain it would put on people that were planning on that money for retirement, widows, orphans, if you died, if they taxed that and they took away 20 or 30%, they would end up shelling out in additional welfare benefits to widows and orphans and retirees who were outliving their money. It cost them, when they calculated it, way more than it made them. They were smart enough to realize in the short run, we might bring in this much tax revenue, but in the long run, we're going to shell out this much. Now, Congress actually does stupid things like that many, many times. But in 1990, they knew better. So they said, leave it alone. It will not make us money. It will cost us money. Now, the second reason is actually sort of comical. If you read between the lines, it was because a lot of Congress people own these policies. And they didn't want to shoot themselves in the foot. They didn't want to hurt themselves. A lot of banks, credit unions own these policies, and they didn't want to bugger that up. So they said, don't rock the boat, leave it alone, because this is where we have our money. Okay? Now, the third reason, they basically said, if we ever did consider taxing these, the inside buildup inside of an insurance policy, we would recommend grandfathering because the precedent has always been set. So what's grandfathering? That means Congress is never supposed to pass new tax law that adversely affects something you did under previous tax law. In this example, you're grandfathered. You don't have to abide by or adhere to the new tax rules because you established your account, you took out your insurance policy before those applied. And that precedent has been set. So example, when Universal Life first came out in 1980, quickly in 1982, the TEFRA Act was passed, requiring a certain amount of insurance had to be attached to the account or it would violate the definition of tax-free under Section 72E and 7702 and 101A of the Internal Revenue Code. They didn't know what they were doing and they had to redefine it in 1984 with the Deficit Reduction Act. So that's TEFRA-DEFRA. I had my first Universal Life policies prior to TEFRA and DEFRA. I didn't have to abide by TEFRA and DEFRA on those. I was grandfathered. I was home free. Same thing with TAMRA. I put in lump sums prior to 1988. After 1988, you couldn't put in one fell swoop and fund it in one single payment, or else you wouldn't have tax-free access down the road. I didn't have to comply with TAMRA on the ones I took out prior to 1988. I was grandfathered. I never had to comply with that. Only the policies I took out since then. This is why many people hurry and are taking out universal life insurance contracts and getting grandfathered. So if Congress ever did anything stupid and tax revenuers wanted to change the tax laws, they'd be grandfathered. Now, I can't guarantee grandfathering, but I think it's the ex post facto provision of the Constitution that says you're not supposed to pass new laws that adversely affect something you did under previous tax law. Yeah, Congress seems to get away with doing all kinds of stupid things, but I feel pretty good that we're protected here because the insurance industry is one of the strongest lobbies in America and the world. If they buggered that up, most of these Congress people would probably be voted out of office. And so that's why I feel like grandfathering will be here to stay because they've always allowed it. The precedent has been set. And that's why I like to put my money into something based upon the actual history that will likely pass any scrutiny or changes in tax law in the future, which I think is highly unlikely in the first place. So if this is intriguing you and you want to learn more, subscribe to this channel. I'll look at some of the other educational videos that I have posted to answer questions about taxes, how to prepare for retirement and convert to tax-free and get grandfathered. I want to empower you. Click on this episode next. And if you want, you'll have opportunities to get some of my books and other training, and you can listen and learn and watch and learn. Whatever medium you learn by best, I am here for you for your brighter future.